Margaret Ellis sat at her kitchen table on a Thursday morning, 3 days after burying her husband of 41 years. The funeral home needed $600 by Friday afternoon, or the payment plan she'd agreed to would default. She had access to a joint checking account with over $30,000 sitting in it. She drove to the bank herself, brought the death certificate, her identification, and their marriage certificate from 1983. The bank told her no. Not because she wasn't entitled to the money, not because anything was wrong with the account. She was told no because of one line on one form that had never been updated in 19 years, sitting quietly in a filing system she never knew existed until the exact week she needed it most. This is not a rare glitch. This happens every day in every state to families who did everything they were told to do. They had a will. They had an attorney. None of it mattered in that moment because the bank does not look at your will when you die. The bank looks at one specific form on file, and if that form is wrong, outdated, or never completed, your family is locked out the moment you die. Not eventually. Immediately. My name is Thomas Whitfield. For over 2 decades, I've worked directly with retirees and their families at the exact moment their finances collide with the banking and probate system. Sitting across the table from bank compliance officers, probate clerks, and estate attorneys, watching families discover, always too late, what the rules actually say. If this is useful to you, go ahead and subscribe, because every week I break down exactly what the system won't explain to you on its own, until it's already cost you something. Here's what almost nobody is told, and it's the most important thing in this video. This is not a failure of planning. It's the system working exactly as it was designed to work. The problem isn't that people fail to plan for the future. It's that people plan using the wrong document because nobody ever told them which document actually controls. Every state that has adopted the Uniform Probate Code, and the majority have in some form, treats one thing as controlling the instant a person dies: the beneficiary designation on file directly with the bank. Not your will. Not your trust, unless that specific account was formally retitled into the trust's name, a separate step most people never complete. The form on file at the bank, and only that form, determines what happens to the money the moment you pass away. Let me walk through the failure points I see most often. The first is the belief that a will controls everything. It doesn't. A will only controls property that passes through probate, and probate isn't fast. Depending on the state, it can take months to over a year before a dollar is released. Funeral costs and mortgage payments don't wait for probate, but probate doesn't move fast enough to cover any of it. The second is the outdated beneficiary form, the one that caught Margaret Ellis specifically. Banks maintain a payable on death, or POD, designation for each account, separate from anything an attorney drafts. If that form was completed decades ago and never updated, whoever is named on it is who the bank pays, regardless of who your current spouse is. Courts have upheld this repeatedly, even when it contradicts a newer will. The third is assuming marriage alone is protection. Many couples believe that because they're married, everything automatically transfers to the surviving spouse. In a number of states, that's simply not true unless the account is specifically titled as joint tenancy with right of survivorship, a distinct legal designation that has to be created intentionally, in writing, at the bank. Marriage alone doesn't create it. The fourth involves accounts held individually rather than jointly. If an account exists solely in one spouse's name, with no POD designation, it goes through full probate regardless of how long the couple was married. I worked with a widower whose late wife had managed household banking for 3 decades, using accounts opened in her name only, purely out of habit. When she passed, every one of those accounts froze completely, and he spent nearly a year in probate court accessing money that had always functioned as joint household savings. The fifth involves retirement accounts specifically, which operate under separate rules held by the plan administrator, not the bank. I've seen a first spouse from a marriage that ended in divorce 20 years earlier still listed as primary beneficiary, simply because the paperwork was never updated. The current spouse, married for 2 decades, had no legal claim, because the account doesn't look at your current marital status, only whatever name is on that form. Here's what happened after Margaret Ellis was turned away. She called me 2 days later with a funeral home deadline less than 48 hours out. What we found was that her husband's account had been opened decades earlier as a convenience account. She had signing authority to help pay bills, but was never formally established as a survivorship owner. That invisible distinction, sitting unnoticed for 19 years, was the entire reason the account froze. We couldn't fix the account status after the fact. What we could do was request an emergency release for funeral expenses, an exception many states allow, and begin a simplified small estate probate process for estates under a certain dollar threshold. It still took 19 days of Margaret covering costs from her own savings for a problem that 10 minutes of paperwork, completed at any point over 19 years, would have prevented entirely. Contrast that with a retired schoolteacher named Robert, whose wife had read a similar story years earlier and proactively updated every one of their joint accounts to joint tenancy with right of survivorship status. When she passed away, Robert had full access to every account within 48 hours. No probate delay, no frozen funds. The difference wasn't the size of the estate or the quality of legal advice. It was 10 minutes of paperwork, completed proactively rather than discovered too late. I also want to flag one more mechanism that trips up families just as often, adding an adult child as a joint owner rather than a POD beneficiary, purely for convenience. That child typically gains full legal ownership immediately, not just after death. I've seen a mother add her eldest daughter as a joint owner to help manage bills, only for that account to pass entirely to the daughter when the mother died, regardless of a will specifying an equal three-way split among her children. If your goal is simply help managing accounts, the correct tool is a durable power of attorney, not joint ownership, which terminates automatically the moment the account holder passes away, so it offers no help during exactly the window we're discussing. One more warning worth including here. In the days immediately following a death, obituaries become public, and this creates an opening for scammers who specifically target grieving families, calling to verify account details or social security numbers under the guise of processing the estate. No legitimate bank will ever request that information over an unsolicited call. If you or a family member receives one, hang up and call the bank directly using a number from a printed statement, never a number the caller provides. One more question I hear constantly. Does this vary by state? Yes, in meaningful ways. The Uniform Probate Code is a model framework, and while most states have adopted some version of it, the exact dollar threshold for simplified small estate probate varies enormously. In some states, it sits under $50,000, in others, well past $150,000. If you don't know which category your state falls into, you don't actually know how long your family would wait if probate became necessary. That's worth confirming directly with a local probate clerk rather than assuming based on something you read about a different state. There's also a real difference between accounts at a traditional branch bank and accounts at a fully digital bank or credit union. If your bank has no physical branch, updating a POD designation often means navigating an online portal rather than confirming the update in person with a representative. I've seen situations where a family believed an online update had gone through, only to discover after a death that the submission had failed silently, with no confirmation email and no follow-up from the institution. If your accounts are digital only, request written confirmation after any update and follow up by phone within a week to verify it was actually processed. I also want to address blended families specifically, because remarriage creates one of the most common and costly gaps I encounter. If you remarried after a previous marriage ended in divorce or death, it's worth checking every single beneficiary designation you hold, bank accounts, retirement accounts, and life insurance policies alike, because these are frequently never updated after a remarriage. I've worked with cases where a first spouse, from a marriage that ended 2 decades earlier, was still listed as primary beneficiary on a retirement account, simply because nobody ever revisited the paperwork after the second marriage began. The plan administrator has no obligation to flag this discrepancy on their own. They simply pay whoever is named on the form, regardless of how outdated that name might be. Another area worth understanding is what happens with safe deposit boxes specifically, since these are often overlooked in conversations about account access after death. In many states, banks are required to seal a deceased person's safe deposit box until a court-appointed executor is granted access through probate. I've worked with families who assumed a spare set of house keys or important documents stored in a box would remain accessible to a surviving spouse, only to discover the box stayed sealed for months. If you maintain one, confirm with your bank whether a joint renter is listed on that box specifically, since box access is not always automatically linked to account ownership, even at the same institution. I also want to be direct about a myth I hear constantly, that a power of attorney remains valid after death, allowing a designated agent to keep managing accounts to handle final expenses. This is incorrect in every state I'm aware of. A power of attorney terminates automatically the instant the person who granted it passes away. Whatever authority existed while someone was alive disappears immediately, which is precisely why POD and TOD designations matter so much specifically for the period right after a death, when a power of attorney offers no help at all. Let me add a brief but important note on scams, because this window of vulnerability attracts more than just paperwork gaps. In the days after a death, obituaries become public, and this creates an opening for callers who specifically target grieving families, asking to verify account or social security details supposedly to process the estate. No legitimate bank will ever request that information over an unsolicited phone call. If you or a family member gets one, hang up and call the bank directly using a number from a printed statement, never a number the caller provides. One last myth worth clearing up: many people believe adding "in trust for" to an account title is the same as fully transferring it into a properly established trust. It isn't. Banks treat an informal "in trust for" designation similarly to a basic POD form, while a full trust transfer requires separate paperwork, typically including a copy of the trust agreement itself, filed directly with the bank. Confusing the two has cost families real time and legal expense, sorting out what should have been simple. It's also worth understanding that most surviving spouses do not become personally responsible for a deceased person's individual debts simply because they're managing the estate. Generally, an individual's debts are paid from that person's estate during probate, not from a survivor's personal accounts, unless the survivor specifically co-signed for that debt. If you ever get a collection call after a death asking you personally to pay a debt held solely in the deceased's name, confirm with an attorney or the probate court whether you actually owe anything before paying. In many cases, you don't. Here is what actually prevents every one of these failure points, and it takes far less time than people assume. On the small estate process specifically, most states require a mandatory waiting period after death, often 30 to 45 days, before a simplified small estate affidavit can even be filed to allow other potential creditors or heirs time to come forward. That means even in states with a simplified option available, families are often still facing several weeks of frozen access at minimum. This is exactly why POD and TOD designations matter so much. They bypass probate and any waiting period entirely, transferring directly to the named beneficiary the moment a death certificate is presented. Step 1. Call your bank and ask specifically for the payable on death or POD designation form for every account you hold, checking, savings, and any CDs. Step 2. Confirm out loud exactly whose names are currently on file for each account. Don't rely on memory. Step 3. If any names are outdated, incorrect, or missing, complete the updated form in person and request written confirmation it's been recorded. Step 4. Keep that confirmation somewhere your family will actually find it, alongside your will, not filed away at the branch, and tell at least one trusted family member where it is. Step 5. Check every account separately. A checking account, savings account, and each CD may each require their own designation. Step 6. For brokerage or investment accounts, ask about a transfer on death or TOD designation, which serves the same function. Step 7. Review beneficiary designations on retirement accounts and life insurance policies through the plan administrator directly, not your bank, and correct anything reflecting an old marriage or a beneficiary who's since passed away. Step 8. Revisit every designation at minimum every 3 years or immediately after any major life event, a death, a marriage, a divorce, a new grandchild. One note on trusts specifically. A revocable living trust only controls assets formally retitled into that trust's name. If your bank account still lists your individual name, the trust has no authority over it when you die, regardless of what the trust document says. This is one of the most common and costly misunderstandings I encounter. People pay an attorney to create a trust, then never complete the second step of actually transferring accounts into it. Margaret Ellis had a will. She had an attorney. What she didn't have was 10 minutes of updated paperwork at the bank, completed at any point over 19 years. That single gap cost her family access to their own money during the exact week they needed it most. Right now, today, your own accounts may be sitting in exactly that same gap. Not because you've done anything careless, simply because nobody has ever specifically told you to check. The system isn't broken. It's working precisely as it was designed to work. The only real question is whether that design is currently working in your family's favor or quietly against them without either of you knowing it yet. Call your bank this week. Ask for the payable on death form by name. Confirm exactly who's listed on every account, and do the same for any retirement accounts and life insurance policies. In most cases, this takes less than an hour, and it costs nothing at all. If you found this useful, subscribe. Every week, I break down exactly what the system won't explain to you until it's already too late to fix easily.